Hello everyone, welcome to Options Discovery on John Lothian News is the Spread. My name is Esma Awas and I'll be your host throughout the series. Just like you, I'm no expert, but with the help of some, we can learn more about options together. In this episode, we will be talking about covered call ETFs, specifically Jepi and Jepq. Later, I will sit down with Rich Excell, an experienced portfolio manager, and he will go into more depth about the two JP Morgan covered call ETFs. Stay tuned for that interview. Before we get into covered call ETFs, let's review the basics of standard ETFs. An ETF, or exchange traded fund, trades like an individual stock but pools together a basket of securities. ETFs can have a variety of investments, including stocks, bonds, and commodities. Generally, ETFs follow a particular index. For example, SPY tracks the S&P 500 index. You may be thinking that ETFs sound a lot like mutual funds, but there's a few key differences. Unlike mutual funds, ETFs can be traded all day on an exchange with fluctuating prices. ETFs can be advantageous over mutual funds because they often charge lower fees. Now that we have the basics of an ETF down, let's talk about covered call ETFs. A covered call ETF writes out-of-the-money call options on securities that the ETF holds. Investors receive the benefit of writing call options without having to participate in the options market directly. Another benefit is that this ETF can guard against volatility. Returns from covered call ETFs will be higher when market volatility is high, but the actual ETF will be less volatile than the market. Speaking of volatility, covered call ETFs tend to do well in a bearish market, or when volatility is high. On the other hand, covered call ETFs are not as profitable during bullish years where growth is consistent. We'll talk more about this later in the episode. In this episode, we're going to focus on two actively managed JP Morgan covered call ETFs, Jepi and Jepq. Let's first take a look at Jepi. Jepi is an income-driven ETF that was launched in 2020 and holds the S&P 500 as its benchmark. Jepi has 135 holdings, with its top holdings being Microsoft, Amazon, and Adobe. Jepi has 13 sectors, including large sectors in financials, healthcare, and information technology. Since its launch in 2020, Jepi has grown considerably. Its value of investment is now $26 billion, and annual expenses are 0.35%. Now that we have an overview of Jepi, let's talk about Jepq. Jepq is an income-driven ETF that was launched more recently than Jepi in 2022. It holds the Nasdaq 100 as its benchmark. Jepq has over 80 holdings, with its top holdings being Microsoft, Apple, and Alphabet. Jepq has 12 sectors, and information technology holds a little over 40%. Since Jepq's launch was more recent, it has a smaller value of investment that sits at around $3.2 billion. Jepq has an annual expense of 0.35%, which is the same as Jepi. Now that we're up to speed on the facts of covered call ETFs, specifically Jepi and Jepq, let's go into more depth about the two. To do that, I sat down with Rich Excell, an experienced hedge fund portfolio manager who also teaches finance courses at the University of Illinois. Without further ado, please enjoy this week's interview with Rich Excell. Hello everyone, welcome to another episode of Options Discovery. Today I'm going to be sitting down with Rich Excell. He is currently a clinical assistant professor at the University of Illinois at Urbana-Champaign, and he's an experienced senior portfolio manager. Rich, can you give us a little bit of a background and how you got to where you are today?
Yeah, it's a long story actually, but I started my career. I graduated from U of I back last century and started my career trading on the floor at the Chicago Mercantile Exchange as a market maker, options market maker in foreign exchange. I quickly moved up to the upstairs OTC business and ended up moving to Asia for most of the 90s. And then I moved back to the US and switched out of the investment bank sales and trading into the world of hedge funds, and did that for the next 20 years through 2020. And again, got to get a chance to live abroad and work abroad, et cetera, on different hedge fund strategies. And then in 2016, I started kind of going down to U of I because I had a daughter down there, and we started to work with students, teach one class here or there. And before I knew it, I was teaching 2 classes per semester. And then I decided I was pretty busy, so I'm like, I have something's got to give. So I retired from the world of managing money for people and now focus fully on teaching at U of I, where I teach a number of different things, including derivative strategies type ideas. And then I do a lot of consulting in the options world as well. So that's kind of how very quick overview of where I've got. But options have been a part of my life really since I interned during my college years.
It's funny that you mentioned Champaign because I'm actually a UIC student, so we're kind of like sister universities, I guess you could say. Um, but
Absolutely.
yeah, how did you use different option strategies in your career as a portfolio manager?
So, when I managed portfolios for the investment bank, that was really kind of global prop trading. And so we used a lot of option strategies for kind of tactical directional trading, maybe for implementing carry trade ideas, et cetera. And that was a time, early days, especially over the counter, where exotic options were becoming very, very popular. And so there was a lot of edge that we could kind of pick up on some carry trade ideas, et cetera. When I moved to the world of hedge funds, and really started my career in equity long short. I kind of came at it again I'm coming at from a world of a macro background. I'd gotten my CFA charter, so I understand. I was really well versed in bottom up fundamental analysis, but I felt my competitive advantage versus a lot of people was understanding the macro environment, one, but two, understanding how options are priced and what the market is telling you about that. And so if I think about it from a fundamental equity analyst, for instance, perspective, when you're building out a target price in your model, you're building a DCF model, you're building a target price. Really the better models are the ones that do a scenario analysis and they think about what could go right. A bullish case. What if my forecasts could be even better than I thought, or what could go wrong? What if a bearish case? What if my forecasts are too optimistic already? And so right there, even with 3 data points, you're starting to develop a distribution of outcomes. And so as a fundamental analyst, you have a view on a distribution of what could happen to any particular stock. Well, now you can take that distribution, you can look at what's being priced in the options market, and you say to yourself, okay, well, what does the options market think about what's going to happen in this particular stock? And so then when you compare those, more than just simply buying a stock or selling a stock or going long or going short, you can start to say, okay, maybe there are better ways for me to express my long or short ideas using option strategies. They don't have to be sophisticated, but even some sort of option strategies that will give me leverage to win when I'm right, or give me some built-in risk management when I'm wrong. And so that's kind of how I really, in an equity long short portfolio, really started to use a lot of option strategies. Now, of course, you can also do them where you can do calendar spreads around particular catalysts, et cetera, and that's really effective. And often, the beauty of options is you don't have to have a directional view, right? Sometimes your view might be on, I think nothing's going to happen, or I don't know which way it's going to move, but I think it's going to move a lot. And so I think there's just a lot of different ways you can really express yourself with options, more so than just a linear buy or sell a stock that I think really provides a competitive advantage. Now, of course, you have to know what you're doing with those, and then you have to actively risk manage those. They're not typically set it and forget it type strategies. But for me in my career, whether it was in kind of macro global prop or in equity long short, et cetera, that's I found that my competitive advantage was using different option strategies. And then for a short time around the financial crisis, I also ran a tail risk fund where we're looking for asymmetric payouts in the case of cataclysmic events, and that's right up the alley of using options across different asset classes, et cetera. So I've always actively looked to use option strategies. I've always looked to the options market for the information that comes from it. I think there's a lot of information investors could glean from the options market if they know where to look. And then that's really ultimately what we're trying to determine as any sort of investor or trader is we have our own views of what's going to happen, but what's being priced in and where's my view different? And then so I think that's where there's a lot of value that we can get from options.
So your use of the option strategies has been pretty versatile over your management career. Pivoting away from your management part of your career, can you tell our viewers a little bit more about your blog, Excell with Options? What influenced you to start this blog, and what kind of options-related content do you cover?
Sure. So it kind of before Excell with Options, I I would always write, a chart of the day or do something every day on LinkedIn. And I did it. I started to do it really actively when I started teaching, and I did it as a way to kind of engage with the students and show them, okay, this is the types of things you should be thinking about. And I would talk about it in class. I'm like, I'm going to put it out every day on LinkedIn to have a look. We'll talk about it in class. I wanted to try to encourage them to do the same, to kind of put themselves out there in a positive light on the social media and show people what they knew, et cetera. And what I found is that it was getting a lot of traction, not just with my students, but with other people as well. And so I kind of kept doing it more and more, and kind of got into writing some other blogs. And then it was the CME that approached me and said, "Hey, would you mind, or would you be interested in doing something where you look across our different products and come up with kind of different option strategies?" Because the CME is always trying to appeal to different audiences. For some products, they're looking to appeal to more retail audiences, and other products they're looking to appeal to more institutional audiences, depending on where they think they need to work. And so I partner with them, and I look across every other week. We look at a different CME product, a different business group, everything from crypto to agriculture to interest rates, FX, equities, energy, metals. And so for me, it's exciting because it kind of goes back to my days when I did global macro and have to look at all the different asset classes and kind of quickly come up to speed on what's the driving force, et cetera. And then what I think is the right option strategy. It's also exciting to be able to engage with the people in the business and think about where we can kind of meet the potential audience on what's interesting to them. And so I really enjoy doing it. It's gotten some pretty good traction with the audience. I think it would just try to, again, I don't put it we every other week we put a trade idea or two out there, and the goal is not that you should follow these trade ideas and make money. That's not the goal at all. We're not trying to give investment advice. The goal is to show people what's possible. Like, if this was your view or you were thinking something like this, consider doing this sort of strategy, because the options market is pricing X, and therefore you should take advantage of what the market's giving you to express your view in this way. And so it's really done from an educational light to trying to say, the best thing to do is to take what the market's giving you. If the market's bidding up downside puts and you're bearish, you might have to find a way to sell puts even within a bearish context, because you don't want to be buying what everyone else is buying or selling whatever everyone else is selling. And that's really kind of the premise. But again, I look at it and I approach it from the light of what I've done in kind of from a macro perspective, and it helps keep me current. And so I really enjoy doing it.
I think that's a really interesting how you kind of started it for your students, and then it's evolved to this larger educational blog. I'm going to be holding my professors at UIC to that same standard now.
I encourage you to do it. I mean, it's great. I tell you what, a lot of my colleagues at U of I started to read that. They would use some of my charts in their classes, and then now increasingly more and more of them are doing it themselves. And I think it's awesome. I think it's just more people putting out good content that helps demystify finance for everybody. I think is only a good thing.
Yeah, I think that's great. And I've seen a few of your Stay Vigilant blogs on LinkedIn. But no, thank you for giving a little bit of an introduction to yourself. We're going to be talking about the main topic for today, which is covered call ETFs, specifically Jepq and Jepq, which are the two JP Morgan covered call ETFs. But before we get into that, can you talk a little bit about what covered called ETFs actually are, and what are some of the advantages and what are some of the disadvantages?
Sure. So I think when you think about covered call ETFs, I think it's important to break it down into two component pieces. First is a covered call strategy, and then the second is doing that within an ETF. Okay, so for a covered call strategy, those have been around for a long time, right? It's not just been the purview of hedge funds. In fact, it's been the purview of a lot of financial advisors or institutional investors that would hold stocks and want to overwrite their holdings with calls, et cetera, as a way to increase, take a little bit of yield and income out of the market while they're waiting for something to happen. And it kind of harkens back to a study by an investment consultant, Callan, back in 2006, which is kind of really the big study that people kind of point to that showed the advantages of covered call strategies. And it looked at a period from 1988 to 2006 and showed that there's just the SIBO buy right strategy, that's the BXM index. If you compare that to the other broad indexes, it had at that time, and that for that period, that 18-year period, it had same returns as the SPX at half the volatility. And so the risk adjusted returns were superior. And it had actually had better returns than the Russell and better returns than bond market, same volatility. And so, it was, if you think of it from an efficient frontier standpoint, it was a superior strategy to all of them. And so, of course, money flows into that, right? Money flows into it at the institutional level, et cetera. And so if we updated that study as of today, last time I looked at it was like 2021, the returns to that strategy has suffered a little bit, but it still has superior risk-adjusted returns. It doesn't have the same returns as the SPX, but it really does a great job of reducing volatility. And so when you think of a covered call strategy, what are the three component pieces? Part one is passive equity exposure, being exposed to whatever index you want to be exposed to. Now, part two is volatility risk premia, and being able to take some of that implied volatility risk premia above the realized volatility, take that out as income. And then is market timing, and that comes down to how the strategy is actually executed. And that kind of gets into some of the differences on the different benchmarks of the different strategies, and we'll talk about that later. But then now you think about, why do this within an ETF and not within a mutual fund or within some other sort of strategy? And that kind of gets to the tax advantage nature, the tax efficient nature of an ETF structure versus an actively managed mutual fund. Now, these are actively managed, but because you're rolling the kind of the call override over and over. However, because of an ETF structure, there are minimal capital gains that the investor has to pay. Mutual funds have to pay capital gains not just on how the overall mutual fund does, but on every transaction the mutual fund manager does. And so ETFs have a superior tax efficiency to mutual funds. And that's why this becomes, there still will be capital gains within this, but that's why this becomes, within an ETF structure, a more appealing way to do a covered call strategy, unless, of course, you're doing it in a pension fund or an IRA or some other sort of tax efficient vehicle. And so the covered call within the ETF structure that the JEPI and JPQ are probably two of the biggest to do, is really aimed at taking, again, this covered call strategy, which has shown superior risk adjusted returns, and putting it within a tax efficient structure.
Thank you for watching this episode of Options Discovery. I hope you learned a little bit more about covered call ETFs. I also want to say thank you to Rich Excell for participating in this week's interview and sharing his knowledge on JEPQ and JEPI. Stay well, everyone, and I'll see you all in the next video. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.